Hello students and welcome to the lecture. So students, as we know that we are covering the financial system, and basically in the financial system, we have started the stock market indexes, right? We had started the topic of stock market indexes. In the subheading, or you can say in the main heading, we have these subheadings. Like we have to discuss the introduction part. Okay. Like we have to discuss the introduction part, then the historical overview, detailed history, types of indexes, formation of indexes, weighting method, and the conclusion. Okay, so you can say that these are the topics we have arranged for the discussion under this series. Out of this, basically we have done with the introduction and the historical overview. In this lecture, we will finish the detailed history, types of indexes, formation of indexes, weighting method, and the conclusion. It means that the Indian stock market indexes we will finish in this particular lecture. So might be the speed you feel somewhat, you can say faster, but please remember that all of the things we are going to see here, these are the things which we had already discussed in the previous lectures. We are basically concluding them, or you can say revising them. Okay. So about this, basically you can say about this we had discussed in the previous lecture. Now this one, formal stock exchanges like the Bombay Stock Exchange were established in the 19th century, and the Companies Act of 1850 and the concept of limited liability spurred investors' interest in corporate securities. Regional stock exchanges were also established in the major Indian cities. Okay, so basically here is the first thing which we are seeing here. It is known as the Companies Act 1850. Like, what does it mean? Okay, so basically if we talk about the England, okay, from where the East India Company belongs. In England, basically the merchant guilds had power to regulate the trade unions. Okay, basically the merchant guilds had the power to regulate the trade unions. All right. So here is the concept of unlimited liability on that time. Okay. So what do you mean by the unlimited liability and what do you mean by the liability? Limited liability, we have to understand these two concepts. Unlimited liability and limited liability. Okay. So let's take a two cases. Here is case of unlimited liability. Here is case of limited liability. Okay. So for example, suppose in the limited liability, the XYZ having asset of 200 crores, liabilities of 300 crores. While in this case, unlimited liability, the XYZ having asset of 200 crores and liabilities of 300 crores. Here, there are 5 owners or the members, you could call it. Here also 5. Okay. So when we talk about these cases, so basically you could see that these companies are insolvent. Why? Because the assets are lower than the liability, or you can say the liabilities are higher than the asset, which we had already discussed in the concept of IBBI. All right. So basically what will happen, that in the limited liability, the creditors to whom the XYZ had the commitment, the creditors could not touch the personal property of these 5 members. Okay, it means that if they have to recover the 100 crores which is showing in the deficit here, these 100 crores could only be generated by the securities and assets of the XYZ. No private property of the founding members will be hurt or touched. While in the case of unlimited liability, if the creditors are not getting resolving of their commitments which were to the sides of the XYZ, or you can say the XYZ is unable to resolve the, or you can say to satisfy the commitments towards the creditors, then the creditors could touch the private property of the owners, or you can say these founders. Okay, so this is the basic difference or the only difference here. Like in the limited liabilities, the recovery of loss could be possible only by the securities and the assets of the company. No security and you can say asset of the member will be touched. But in case of unlimited liability, the creditors could easily access to the private properties of the founders or the members and could sell off them so that they could recover their losses. Okay, so during this time period, or you can say during 1800s to 1900s, basically what's happened, that the major, you can say the companies and the trade unions were under the control of merchant guilds, and there was a concept of unlimited liability. Okay, and that is not so good. Why? Because it is not just closing the company, but also you can say affecting the founders and the owners. All right, and making them unable to open the new company. All right, so that's why finally the concept of Joint Stock Companies Act 1844 was brought to the light. Joint Stock Companies Act 1854 was brought to the light, and that makes the concept of limited liability in England. Okay, that is the one thing. Similarly, what's happened, that it was a time period of 1850 when the Companies Act was formed. But you could say that the base of this act, the base of this act was belong to where? Was belong to the Joint Stock Companies Act 1844. Okay, remember this thing. Got it? So here it is written down. Like the limited liability was brought to India through the Companies Act of 1850, which means that if the company is getting insolvent, then the, you can say, loss could be recovered only by selling of the assets and the security holding by the company. No private property of the owners will be touched. Okay, and also the regional stock exchanges were also established in the major Indian cities like the Kolkata Stock Exchange, okay, Surat Stock Exchange, Ahmedabad Stock Exchange, like this. Now, in the detailed history, we have the pre-independence in 1947. Before this, what was happening? After India's independence in 1947, the stock market underwent changes to adapt to the new economic environment. Why? Because prior to this, major stock market activities were under the control of British government. So remember this thing. Like before independence, the British government had the entire control over the economic sphere of India. That's why all of the stock market activities which were happening in India, these activities were under the control of the British government, or you can say who are actually driven towards British interests. Okay, remember this thing. But when we got the independence in the 1947, then the economic sphere were transferred to the independent Indian government. Okay, which means that now the independent Indian government had the responsibility to run the stock market. Now here is one thing before we go further, let me tell you that in 1867 there was some thing happen, and the thing was that there was a consolidation of, or you can say consolidation and amended laws relating for incorporation, regulation, and you can say winding up of trading companies and other organizations. Okay, in 1867 there were so many laws existed in India. Okay, that's why what the British government did, they consolidated and amended the laws which are related for the incorporation, regulation, and winding up of the trading companies and the other organization, so that the common framework could be derived. Right? So keep this thing in your mind. Thereafter, 1950s to 1960s, evolution continues. Former stock markets trading continued to evolve, with several regional stock exchanges became operational, like we have seen the Calcutta Stock Exchange, the Surat Stock Exchange, the Ahmedabad Stock Exchange. However, the market remained relatively small and primarily served British colonial authorities and their commercial interests. Okay, relatively small. Why? Because it was mainly centric for the British interest. Why? Because no, you can say major Indian investors, no major Indian traders, okay, no major Indian companies were participating into the, you can say, the stock markets. Only the companies or the organizations which were there, mostly of them are belong to the British or the Europeans. Okay, that's why they were inclined to serve primarily the British colonial authorities and their commercial interests. Okay, late 20th century transformation. The late 20th century marked a significant transformation with the establishment of the NSE in 1992. This introduced electronic trading and the modern technology, enhancing the market transparency and the efficiency. Like you could say that from 1875 till 1992, there was only one, you can say, the organization operating in India for the share market was Bombay Stock Exchange, BSE, right? And BSE was primarily, you can say, or you can say mostly, was ruling or dominating by British companies and public companies after independence. All right. But what happened, like in the 1992, when the government established the National Stock Exchange, so what the NSE did, that first of all, it transformed the old traditions of the Bombay Stock Exchange, which were primarily focused on the British colonies. Second, that this provided the way for the Indian companies and the Indian organizations to come forward and evolve themselves. Benchmark indexes and the scandals. You could say that the NSE introduced the Nifty 50 index, providing a benchmark for the Indian stock market. However, this decade also saw the scandals like the Harshad Mehta scam, raising questions about the regulatory oversights. Okay, so what is the Harshad Mehta scam? Basically, if you want to see this, okay, if you want to, you can say find out about this, then there is a series online which you could see. It's Scam 1992. Okay, this series is a detail about the Harshad Mehta life story and what is the scandal. All right. And thereafter, if you go forward, then there is a one scandal also. This is known as the Ketan Parekh scam. Okay. So Ketan Parekh scam, which was registered in the early 200s or 2000s, this scam was basically, you cancel it with the insider trading. So what do you mean by the insider trading? Insider trading means that having access to inside or confidential information of company, which is not available for the outsiders. This side, insider trading, we had already discussed. Okay. So here I'm just reminding you. All right. So it was the insider trading scam. Due to this, that was the year of 2002 when the strict regulations were brought for the insider trading by the SEBI. All right. Economic reforms and globalization. India initiated economic liberalization and reforms in 1991, attracting foreign investments and transforming the economies and the stock market. This is what we have already discussed. Thereafter, demutualization and the regulatory framework. Early 21st century. Indian stock exchanges underwent demutualization in the early 21st century, separating ownership and management. The Securities and Exchange Board of India played a crucial role in regulating and supervising the market. What do you mean by demutualization? It means that only mutual partners working. Okay. For example, suppose if there are 10 companies. Okay. So what is happening that these companies are doing stock market trade inside only or amongst them only. No outsider was allowed. Okay. So this thing was discontinued through the demutualization. Okay. It means that the SEBI separated the ownership and the management so that more and more players could be brought to the market and the, you can say, the fairness could be ensured. Technological advancements such as online trading platforms made stock market participation more accessible because, as we had seen, that no longer physical presence of person is required in the stock market. Okay, why? Now the stock market is on online. It means that doesn't matter where you are, okay, inside the country, outside the country, you could have the access to the stock market through the internet technology. Current state, the Indian stock market has a market capitalization of over 7.5 trillion and offers various online trading facilities. Now you could see that how massive is the Indian stock market nowadays. Okay, it means that all the shares launched by the companies, or you can say all the outstanding shares multiplied by their current price will be used to determine the market value. Okay, so this is the current state. Thereafter, investors education and the awareness programs ongoing. Various initiatives continue to educate investors about the stock market, risk management, and the financial literacy. Okay. Now, types of indexes. First is the sectoral index. Both the BSE and the NSE features robust indicators that assesses the companies within specific sectors. Examples include the S&P BSE Healthcare and SATHE Pharma indexes. Okay, so basically you can say that the sectoral indexes are used to show the performance of the companies which are belong to the same sector. Okay, like here you could see S&P BSE Healthcare. Okay, it means that the companies which are listed under the BSE or the Bombay Stock Exchange, and these companies belong to the healthcare. Only these companies' performance has been reflected in this particular index. Similarly, if we look at the another one, which is the NSE Pharma Index, it means that the companies which are registered on the National Stock Exchange and belong to the pharmacy field. Okay, these companies are known as NSE Pharma. Okay, only those companies' performance will be reflected here. So that's how the sectoral index works. Another example is S&P BSE PSU. PSU means government-owned entities. Okay, and public sector units you could also call them. Okay, like S&P PSU only shows the, you can see the performance of those companies which are governmentally owned, and Nifty 50 PSU only shows the PSU bank's performance. Okay, benchmark index like Nifty 50 comprising the top 50 performing equities, and the BSE Sensex comprising the top 30 best performing stocks are benchmark for the NSE and the BSE respectively. It means that suppose if the NSE has registered this much of companies, and you can say the BSE had registered this much of companies. Okay, so out of these performance of top 50, out of these performance of top 30 will be reflected in these particular index. Okay, and this is done so that the investors could be aware like what is the condition going on. These indexes set high standards for selecting companies, making them reliable indicators of overall market performance. Like if the company has been, you can say, included in any of the share, it means that, any of the index, it means that company has successfully passed the checklist. Okay, so that the information could be reliable. Some indexes, you can say select companies based on their market capitalization, which is the stock market value of publicly traded corporation. About this we had already seen. Okay, like S&P BSE and the NSE small cap 50 indexes. These are those indexes which include the companies which having the lower market capitalization as defined by the SEBI. Like other indexes, S&P BSE 500, NSE 100 and S&P BSE 100. These are those indexes which include the large number of stocks. Investors should focus on areas where they feel secure, as investment portfolios cannot cater to all risk appetites. Like if you having the investment, you want to make the investment, then you are just required to watch carefully the indexes so that you will get an idea like how the market is performing. And once you get the idea, then you can make your decisions wisely. Okay. After the types of indexes, now we have the formation of index. A stock market index is formed by combining equities with similar market capitalization, business sizes or industries. It means that any of the factor could be, you can say, pick up. Each stock is then weighted based on its market price or the market capitalization. This weightage determines the impact of stock market or stock price fluctuation on the index value. Okay, so basically we will see this in the weighting method just right now. Look at it. Okay, so how the indexes you can say prepare. First is stocks are selected based on the criteria such as the market capitalization, business size, or industry. For example, index which is tracking the technological companies is only include the stock of companies primarily involved in the technology sector, so that the similarity could be ensured. All right, no company which belong to some other field like the pharma field, pharmaceutical field and all will be included in it. Okay, so keep this thing in your mind. Weighting of stocks. Each stock in the index is assigned a weightage based on its market capitalization or price. Market capitalization weighted indexes give more importance to the stocks with higher market capitalization, reflecting the relative size of the company in the market. For example, suppose there are 5 companies in the stock exchange. Market capitalization is 45,000, 60,000, 35,000, 20,000, 50,000. This is the market capitalization. So what will be the weightage? As per this, number 1 will be B, number 2 will be E, number 3 will be A, number 4 will be C, and number 5 will be D. So that's how the weightage drive. It means that higher the market value, higher will be the weightage in the index. All right. So keep this thing in your mind. Price weighted indexes, on the other hand, give more weight to the stock with higher prices regardless of the market capitalization. It means that if the prices are high, then it will have the higher value. Calculation of the index value. The index value is calculated using a formula that takes into the account the prices or the market capitalization of the constituent stocks. Changes in the price of the constituent stocks lead to the corresponding changes in the index value. This is we had already discussed in the previous lecture. Adjustment for changes. Indexes are periodically reviewed and adjusted to account for changes such as stock splits, merger, or delistings. This ensures that the index remains an accurate representation of the market or the sector it tracks. All right. Thereafter, maintenance and the rebalancing. Regular maintenance and the rebalancing of the index are necessary to ensure that it continues to reflect the current market conditions. This may involve adding or removing stocks from the index or adjusting the weights of the existing stocks so that whenever the you can say viewer look at the index, the right information should be communicated. So in the weighting method, the first is the market cap weightage. What do you mean by this? So the stocks are chosen based on their market capitalization related to the overall market capitalization of the index. This weightage of the stock exchanges daily with its market capitalization depends on its stock price and the number of publicly traded shares. Okay, market cap weightage means that whatever the market capitalization of the company is, you can say is or will be checked as per the market capitalization of the index. As per this, the weightage will be granted. However, the weightage of the stock changes daily because of the market capitalization. Why? Because it's totally depend upon the stock price, which will be depend upon the demand and supply. And second will be number of publicly traded shares. It means that not all shares will be included, but only the outstanding shares will be included. Thereafter, price weightage. In this method, the index value is calculated using market capitalization instead of stock price. Stocks with higher prices receive more weightage in the index than those with lower prices. Okay, that is what we had already discussed in the previous lectures. Now the conclusion part. In conclusion, we could say the history of the Indian stock market reflects a journey of significant development and transformation. As we had seen that it was started under the banyan tree in 1850, and now when we talk about India, then the Indian market or Indian stock market capitalization is nearly about 7.5 trillion US dollars. Okay, so from banyan tree to here we had, you can say, completed our long journey. from its origin in the late 18th century to its current status as a sophisticated and the well-regulated financial marketplace. Okay. Key milestones include the establishment of the former stock exchanges like the BSE and the NSE, introduction of the benchmark indexes like the Nifty 50 and the BSE Sensex, and the adoption of technological advancement like the electronic tradings brought the revolution in the market, or you can say in the face of development of stock exchanges. Market has faced challenges including scams and regulatory issues, but has continually evolved to meet the need of the investors and adapt to changing the economic environments. Today, the Indian stock market offers a wide range of indexes, including the sectoral indexes, benchmark indexes, and the market cap indexes, providing investors with the diverse options to gauge market performance and make informed investment decisions. Okay. Overall, we could say that the Indian stock market's journey underscores its critical role in India's economic development, attracting both domesticated and the international investors and contributing significantly to the country's growth history or the story. About international investors, we will talk about these lectures of FDI, FII, and the FPI. Till then, just revise the Indian stock indexes. Okay. So students, basically in this lecture, we have finished this topic. In the next lecture, we will start with another important topic. Till then, just revise all the facts and figures we have discussed in this lecture and be ready for the other lecture. Because if you will revise these things on a timely basis, so when we will go further, you will be able to grasp the facts and figures in the proper manner and even attach them with each other so that you could link them better. Okay. With this note, let's end this lecture. And what do we say? We say thank you.